Buffett's post-investment view of Itochu appears to have been very favorable. Berkshire kept increasing its stake in the broader Japanese trading house group, and market commentary in 2026 described Itochu as still having a positive relationship with Berkshire's next leader, Greg Abel. What Buffett saw afterward. After the first purchase, Buffett seems to have seen exactly what he liked at the start. Strong cash generation, cheap valuation relative to earnings and cash flow, disciplined buybacks, and high dividends from a business that had become more diversified and less resource-dependent. Buffett himself said the Japanese trading houses were attractive because of their financial records and low prices, and later coverage noted that these firms kept buying back shares and paying high dividends. Was management doing a good job? Yes, the evidence suggests Buffett would have viewed Itochu management as effective. Itochu's own materials emphasize the brand new deal, downstream profit opportunities, growth investment, and progressive dividends, while also highlighting digitalization and operational discipline through the earn, cut, and prevent approach. Did Itochu hit its goals? Mostly yes, especially on profit growth and shareholder returns. Itochu reported record profits by the mid-2020s and continued to reinforce dividend policy and buybacks, while also saying in 2026 that it was pursuing record high profits again and using a progressive dividend policy. Next 10 years, Itochu's direction for the next decade looks like deepen downstream businesses, keep investing in growth areas, sustain progressive dividends, and continue using capital allocation to raise intrinsic value. Its public management policy says the company is shifting profit opportunities downstream and pushing sustainable corporate value growth, with single-year management plans and progressive dividends now part of the framework. Will it fit Buffett's vision? Largely yes. Buffett's thesis was not just Japan is cheap, but that he wanted durable businesses with cash flow, rational managers, and shareholder-friendly capital allocation, and Itochu has continued to move in that direction. The main risk is that future success will depend on whether management keeps discipline as it grows more complex and more invested in new businesses. A strong way to phrase this is, Buffett bought Itochu because it was cheap and disciplined, and afterward he saw management keep proving the thesis right through profit growth, dividends, and buybacks. Itochu's free cash flow was not very steady from 2021 to 2026, mainly because the company was actively shifting capital, so operating cash flow stayed strong, but investing and financing cash flows swung around a lot. In Itochu's own reports, 2025 free cash flow was 743.0 billion yen versus 481.0 billion yen in 2024. While operating cash flow, investing cash flow, dividends, buybacks, acquisitions, and asset sales all changed meaningfully from year to year. Main reasons. First, Itochu was not running a do-nothing and collect cash model. It kept making large investments in businesses like machinery, food, finance, and the eighth, while also buying and selling stakes such as C.P. Pokphand and increasing investments in Kawasaki Motors and Seven Bank. Second, share buybacks and dividends were substantial and grew as a capital allocation priority. The 2026 report says financing cash flow was heavily affected by dividend payments and share repurchases, which makes free cash flow look more uneven even when the core business is healthy. Third, reported FCF at a conglomerate is naturally noisy because of working capital and deal timing. Itochu's cash flow statement shows changes in trade receivables, inventories, payables, and advances to suppliers, which can move a lot when trading activity expands or when commodity and consumer businesses shift seasonally. What changed in 2021 to 2026? From 2021 onward, Itochu's business became larger and more active, especially in non-resource and downstream areas. That usually means more inventory, more receivables, more acquisitions, and more restructuring, so free cash flow can jump up or down even if long-term value creation is improving. Itochu also said its management policy is now based on the brand new deal, with accelerated growth investments, brand building, and active shareholder returns, including a progressive dividend and at least 300 billion in share buybacks for FY 2026. That is good for shareholders over time, but it also makes cash flow less smooth in any single year. Buffett-style interpretation. From a Buffett lens, this kind of FCF volatility is not automatically bad. What matters more is whether operating cash generation, returns on capital, and capital allocation are improving over time. And Itochu's reports show strong operating cash flow and rising equity while it keeps investing and returning cash.